In 12 months, 4 American tech companies will commit $700 billion to artificial intelligence. Amazon, Google, Microsoft, Meta. This is the exact pattern that destroyed $2 trillion in 1999. Their combined capital spending this year exceeds the annual gross domestic product of Sweden. These companies are not building for next year. They are building for 2030. It is the largest coordinated infrastructure bet in the history of American business. The last time a handful of companies spent this aggressively on infrastructure, they built something that connected the modern world. And then they lost $2 trillion. The industry was telecommunications. 95% of what they built was never used. What follows is the exact pattern, now repeating on a scale 4 times larger. The 1996 Telecommunications Act was supposed to unleash competition. Long-distance rates had been falling. The internet was exploding. Washington wanted more networks, more players, more bandwidth. The law deregulated the industry, and Wall Street noticed immediately. Within 5 years, American telecom companies had poured more than $500 billion into fiber optic cable. They laid 80 million miles of it, enough to circle the equator more than 3,000 times. A pension fund manager in Ohio bought Global Crossing bonds believing they were as safe as treasuries. By 2002, those bonds paid nothing. The players each had their own plan to own the future. WorldCom, led by Bernie Ebbers, became the nation's second-largest long-distance carrier through 65 acquisitions in a single decade. Global Crossing, founded in 1997, reached a market value of $47 billion in just 2 years, on the promise of an undersea fiber network linking every major continent. Quest promised a nationwide internet backbone. Level 3 promised unlimited wavelengths. Williams Communications promised bandwidth at half the incumbent rate. Every company in the industry was racing to build as fast as capital would allow. Internet traffic, they told investors, was doubling every 100 days. Every home, every business, every website, every new online service would soon consume unlimited bandwidth. It sounded inevitable. Federal Reserve Chairman Alan Greenspan called it a new paradigm for the American economy. Investors poured hundreds of billions of dollars into the industry, in both debt and equity. Junk bond issuance hit record levels. Bank loans flowed. By early 2000, telecom stocks alone were worth over $2 trillion. It was the largest capital spending boom in American corporate history. And the CEOs told Wall Street it was just getting started. Then the numbers started to not add up. Internet traffic was growing, but not at the rate the CEOs had claimed. The doubling every 100 days figure turned out to be at best aspirational. At worst, a fabrication used to justify more orders, more debt, more fiber. By early 2001, more than 80% of the fiber that had been laid was dark, sitting in the ground, unlit, unused. It did not take markets long to figure out what that meant. Telecom share prices began to slide. Then they collapsed. WorldCom had been hiding losses for years. In June 2002, the Securities and Exchange Commission announced the company had overstated profits by $3.8 billion. At the time, WorldCom carried $30 billion in debt and employed 80,000 people. Bernie Ebbers was eventually sentenced to 25 years in federal prison. WorldCom filed for what was then the largest corporate bankruptcy in American history. Global Crossing, once worth $47 billion, filed for bankruptcy in January 2002. It left behind $12.4 billion in unpaid debt and thousands of miles of dark fiber on the ocean floor. Quest settled an accounting fraud case with the SEC for $250 million. Level 3 survived, barely, by selling off assets. Williams Communications did not survive at all. Between 2000 and 2002, global telecom stocks lost more than $2 trillion in market value. The S&P Telecom Index fell 95%. Less than 5% of the fiber laid during the boom was ever lit. The capital had not just evaporated, it had gone into the ground. Literally, 500,000 telecom workers lost their jobs. A WorldCom engineer in Mississippi, who had been promised stock options worth $1 million, lost everything: her job, her savings, and the company she thought was unbreakable. The Federal Reserve cut interest rates 13 times between 2001 and 2003. Greenspan's new paradigm was quietly filed away. The shock was not limited to telecom. It helped trigger the broader recession of 2001. And the entire tech sector entered a winter that lasted most of the following decade. Fast forward to 2026. Amazon will spend $200 billion on capital expenditures this year. Google, $185 billion. Microsoft, $145. Meta, up to $135 billion. Together, close to $700 billion in a single year. A 67% jump from 2025. The projections for 2027 are even larger. The argument is familiar. Artificial intelligence will be the next platform. Every company, every application, every search, every phone will run on graphics processing units and massive data centers. Demand is doubling every 6 months, the CEOs say. Training a frontier model now costs over $100 million. Inference costs are growing even faster. No company that wants to compete can afford to opt out. Meta has committed $21 billion to CoreWeave through 2032, on top of an earlier $14 billion deal. Tesla, SpaceX, xAI, and Intel are building a $25 billion chip fab in Austin, Texas. Amazon is turning its custom Trainium chip into a merchant product to rival NVIDIA. NVIDIA itself is investing $2 billion in Marvel for silicon photonics. SpaceX has filed to launch 1 million satellites for data centers in orbit. Every major company is pouring money into AI infrastructure faster than anyone can count. The bond market is lending willingly. The equity market is rewarding every announcement. NVIDIA itself, the picks and shovels supplier, is now the most valuable company in history. And every major company is saying the same thing. This time is different. That is the sentence every bubble repeats. Here is what survives a bubble. The fiber that was laid in 1999 is still in the ground. Most of it now carries traffic. It is the physical backbone of the modern internet. Amazon Web Services runs on it. Netflix streams over it. Every TikTok video you have ever watched has traveled through it. The companies that paid to put it there all went bankrupt. That is the pattern. The bubble destroys the capital. The infrastructure remains. And the next generation of companies, the ones who bought the assets at pennies on the dollar, built the real internet on top of it. Google was one of them. So was Facebook. So was Amazon's cloud business. The bubble built the playground. The winners showed up later. Whether today's AI capex is a bubble is not yet clear. 700 billion is not an opinion. It is a number. So is 2 trillion. So is 95%. The data centers being built today will still exist in 2035. The question is whether the companies building them will. What survives is never the investors who believed. It is the infrastructure they left behind. What happens next will determine whether today's 700 billion becomes the foundation of a new world, or the next ocean of dark fiber